This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wujastyk from TrendSpider. We have a
breaking news. What is up, everyone? Welcome back to another episode of Benzinga Live. Happy Monday. Hope everyone had a great weekend. I've got the S&P 500, the SPY, pulled up right here because we are just about trying to go green.
We just went green, Aaron, I think.
We went green briefly, went back in the red. We're trying to go back in the green. You can see we're down just 0.07% right now, 0.06 now. So yeah, I mean, crazy turnaround of the day. We've been saying it the past couple weeks. We've had these crazy turnarounds. I don't think we can expect anything else right now.
I don't know what to think. I only know what the charts say. It is remarkable. This morning was basically deja vu from Thursday and Friday. Yeah, and markets opened, what, like 2% lower, 1.5%, 2% lower overnight. The futures markets traded down all night, and then the morning comes and we just rebound and we buy the dip. So the SPY is flat. The NASDAQ is green. Again, tech stocks leading the way. So Bitcoin is up because tech is up, right? I mean,
well, I mean, actually, I don't think that's a fair assessment because I was watching Bitcoin before the market opened, and Bitcoin started ripping about 9 a.m. Eastern before the market opened. And if you looked at futures, there was actually a disparity there. I mean, the NASDAQ was still set to open about 1.5%, 2% lower, even as Bitcoin was ripping into the open. So Bitcoin really kind of ran first, and now I feel like tech's kind of following Bitcoin.
Well,
here.
I mean, here, let me. I'll bring up my screen. I see your point that the markets were going to open lower. Here, let's just bring up my pro for a second. So this is the cues. You know, my proxy for tech. And then just out of curiosity, let's just see where if you're right here. So here's the Bitcoin chart. Nope, no Bitcoin chart. Let's try it again. Bitcoin. All right. Weird. Bitcoin dollar. Okay. Not showing up. All right. But the point is, so really from 4 a.m. onward, you know, the cues were trading higher. So if we pull up a Bitcoin chart up here. Oh, wait. You have a Bitcoin chart up, don't you?
I do. Yep.
All right, and maybe better bring yours up because for whatever reason my charts are having a seizure right now. So let's go to yours.
All right,
so,
go to mine real quick.
Okay, so is that a 15-minute? No.
Sorry, I'm just trying to make my watermark a little less. There we go. This is a daily chart on Bitcoin.
Can you zoom in?
Yeah.
Yeah. Oh, now I've got my charts back. That's so bizarre. So the Bitcoin chart. No, my Bitcoin chart is weird. So, all right, your chart is saying.
What do you want? You want to look at a daily?
I just want to look at this morning and like Bitcoin.
Okay,
this
so
morning.
let's go to a 10-minute.
Let's go to a 10-minute chart. I just want to see like this morning and how it compares to the cues because right now they're all green. Everything is green. If you're tech, you're green. Is that? I can't. And we by the way, we will talk about a lot more than just this today. I promise. We have a lot to get to. I want to talk about.
Wait, this isn't.
I want to talk about the Berkshire Hathaway letter. All right. Do I need to refresh
my charts are being weird too because this does not look right.
Yeah, no, that's what I'm saying. The charts are acting funky. They were good for me all morning. Now I come on this show. Maybe it's my computer, or I don't know.
No, it's just not showing. I mean,
all right. Whatever. The bottom line here is that tech is up. That's the takeaway, right? Crypto is up. Crypto trades with tech. They're both up. Bottom line. Gosh, you know, I don't know why that is. It is. I mean, and if you look at what's leading here, Aaron, you want to bring up some solar stocks? Solar is ripping today. Did you see that?
Yeah, I have my my favorite run.
Yeah.
Up about 10% today. That was my 20. Last time we checked the 2022 stock of the year, I was in dead last. I would venture to say I'm not last anymore. We should go ahead and pull that up at some point. But yeah, let us know in the chat what you guys are watching. Here, I'll pull up my. Let me see if it's all my charts are being funky or just.
I think it's just the Bitcoin chart.
Just the Bitcoin one.
So Sunrun is Aaron's favorite, but you can look at First Solar, you can look at Solar Edge, you can look at Enphase, Jinko Solar, all these stocks ripping here today. I don't know why. Well, actually, it's weird. I do know. I do have a theory as to why solar is up. One, solar is a growth asset class, a growth industry. So if tech will trade higher, solar will trade higher too, because it's all growth. But two, and this is where it gets a little bit contradictory. Solar is obviously a hedge away from oil, right? Away from reliance on oil. So if people are positing, oh, we should get away from oil, get away from we want to hit Russia where it hurts. We get away from oil. We move to solar. So solar trades higher off of maybe that type of a logical leap. But if you look at oil today, like look at the XLE, it's also trading higher. So like. I don't know. Oil and solar are both green.
Yeah, I don't know how much of solar trading higher can be kind of attributed to the fact that we are going to eventually try to pivot away from oil, take that reliance off of Russia, take that reliance off of countries, wherever they may be, or just the fact that interest rates are set to stay lower, which will then spur more investments into that field just in general.
I don't know. Interest rates are not going to stay lower. We just don't know how high they're going to go, but they're going to will they go up 1 notch or 5 notches is the question.
Well, I think from my understanding, from most experts in the energy field, our best bet in the short term, if we wanted to get away from oil and reliance on natural gas and oil and fossil fuels, would be nuclear. Just because it's right now, we're closer with nuclear to be able to use that to power, the majority of our uses versus solar, which is still years down the road.
I saw that, MD. I watched 60 Minutes last night.
Oh, they had a.
Did
they have Ted Capel on?
There was a whole story on how vulnerable the electrical grid is in the U.S. And then there was another story about the death of newspapers via hedge funds, or one hedge fund in particular.
If you're interested in that topic, there's a book by Ted Capel, who is a journalist, called Lights Out, and it's all about that. It's literally all about how. If
you want to scare yourself, sounds.
But he wrote that like 5 years ago, and I read it and thought like, oh my god, this is like a big problem that no one's talking about. All of our country's electricity grids are on like 3 grids or whatever it is. But yeah, I mean, the energy trade, that's going to be the most tradable asset or tradable industry, I think, throughout this whole thing is energy, whether it's oil, whether it's solar, whether it's nuke. And I don't know, are there any good nuclear energy plays?
Wait, before you ask that, I'm having a huge brain fart right now. What is the ticker for the solar? Oh, TAN.
TAN.
I could not.
Yeah.
I just spent the last 30 seconds thinking about that, and I couldn't. So TAN's up 8.5% today. You asked if there are nuclear stocks.
Nuclear, yeah.
Probably, sure. Easy way to find it is to just Google nuclear stocks. Is what I do. Low key. Yeah. Oh yes, CCL.
CCL's Carnival Cruise Lines.
No, not CCL. What's the other? What is it? Cameco, right? What's the ticker on that? It's not CCL. Sorry.
CCJ.
CCJ. Thank you. I was off by a letter.
Is it nuclear play?
Yeah.
Oh, engages in the provision of uranium. Yeah, up 6% today.
So you can go the U's, right? U. Right? Is another one. Charts look identical. You can go U as well.
No, U is... No, that's not nuclear.
U? Yes, it is.
It says, I'm reading the description right now. Designs, markets a variety of safety products consisting primarily of smoke alarms, carbon monoxide alarms, and related
4
products.
U's or 3 U's?
3 U's.
No, 4 U's.
Oh, okay.
Yeah.
Energy fuels.
Yep.
Got it.
Yeah. Okay. Maybe you're right. I mean, the market is agreeing with you. Clearly, we're a little bit late to this trade. right? I mean,
Yeah, I mean, it's just from what I understand, like, and it's all about risk reward, right? Nuclear energy, out of all the clean energy solutions, has the biggest risks, but you know, if you weigh the risks and rewards and decide that this is a way that we can efficiently and in a tangible way provide energy for the large portion of the country without fossil fuels, and then you try to mitigate that risk of nuclear disasters, they might decide it's worth it. Who knows? And actually, I was surprised. So there's a nuclear plant in Illinois near St. Louis. And I was staying at my buddy's house who lives in that neighborhood. And I guess there's been a lot of, like, I think they're planning on closing it down, or there's talks of closing it down. And literally like 80% of the yards in his neighborhood had yard signs saying they wanted to keep the nuclear energy plant there.
That's interesting.
I guess it has like really good jobs, high pay, and a lot of people would lose their jobs.
Interesting. Yeah, I admit to have a pretty poor feel for what the general sentiment is out there with regards to nuclear power. I know there are some people that are radically against it and radically for it. I don't know where I stand. I don't know enough about it to have an opinion, honestly. But yeah. So
from what I understand, I think if done properly, it's a very good option.
Okay.
The problem is
sounds right.
The problem is if it goes wrong, there's catastrophic fallout, obviously. I also want to talk about the cybersecurity trade.
Yeah. Well, what I was going to say with regards to this, the cyber trade is, that was one of your best trades of the week last week. It's cooled off a little bit here this morning.
I don't know. Fortinet's up 5% right now.
I'm looking at just your sectors, your industries, and uranium and solar are your top two performing industries of the day here. How is the cyber trade doing? Because all those names ripped last week.
FTNT, that's my favorite in this
Fortinet?
space, up 5%.
Yeah,
I mean,
it's
think
having
about
a good week.
So someone in the chat just said Toyota got hacked today.
NVIDIA got hacked.
NVIDIA got hacked.
Yeah.
One of the biggest logistics company in the world got hacked last week. We just talked about, if we need strong cybersecurity to protect the energy grids in the country.
Yeah,
I think this is I don't think this trade is over.
No, and I owned, just so you all know, I own the make sure I have the CIBR, the NASDAQ Cybersecurity ETF. That's what I've got, which holds all this stuff, right? So I've got exposure, and I don't intend to sell that, frankly, ever. But yes, the cyber trade was super hot last week. Look at Palo Alto. Why is Fortnite your favorite, out of curiosity? I don't know enough about. The reason I like the CIBR is because, wow, look at that Palo Alto. Holy crap.
I like, so honestly, and I don't claim to be an expert in this space or really any space, but once during COVID, right, this was another time where the cybersecurity trade just made sense because everything was going online. Companies were, moving everything online. There was going to be more companies that were willing to spend money on protecting their assets that they were, while working remotely. And Fortinet was just one that I traded during COVID. And if you pull up Fortinet's chart, again, the ticker is FTNT, and just look at like a daily throughout that, I mean, it was just such a good run that I don't know how you argue with that.
You talking about from COVID?
Yeah, from like those COVID lows up to...
Not really. I mean, they went from... 70 to so it doubled in like 2 months.
No, I'm talking about from after. I'm talking about from.
Oh, here?
Yeah, that run right.
So this is November 2020.
Yeah.
Yeah. Great, huge run. Yeah, this thing went from 100 to 300, to 370.
And it outperformed. I mean, to me, in the space that was doing really well, for it to outperform. I mean, you look at the year return. It's 100% return on FTNT right now. You look at cyber. It's a 16% return over the past year.
Yep. Someone in the chat asked about IronNet, IRNT. So a few thoughts on that.
I do think the overall markets are kind of giving some up right here.
A few thoughts on this. I can't speak to this business. Okay, I don't know anything about IronNet as a business, but IronNet technically counts as a cybersecurity play. That's the sandbox that they play in. But comparing IronNet to the stocks we just discussed, Fortinet, Palo Alto, even like a Mandiant or a Zscaler or Cloudflare, it's apples to oranges, okay, for many reasons. First off, IronNet is a $500 million company, which in the grand scheme of things is actually pretty small. It makes it a small cap. Okay, the companies that we just talked about, Palo Alto is a $56 billion company. Fortinet is a $53 billion company. So we're talking about companies with market caps in the 50 billion range compared to IronNet, which is a $500 million company. So it's such a small company in the grand scheme of things. That's the first thing. The second thing is the shares outstanding of this thing, 88 million shares outstanding. That's not a lot of shares. It really isn't. Okay, so the float's going to be way less than that. And what that means is it's easier to, not that the stock necessarily has to be or is manipulated, but it is easier to manipulate a stock with a smaller float like IronNet has. The third thing is, as the chat noted, there was a short report out on this stock on Friday by White Diamond, right? Is that what it was? I think it was White Diamond Research. And they gave it a 50-cent price target. Now, I have not read this report. I don't know what it says, but 50-cent price target is pretty dramatic. And the fourth thing I would say is just look at the chart, okay? Again, is IronNet a good business? I have no idea. Is it a good stock? Absolutely not. Stocks that go from 57 to 4 are not good. Sorry. They're just not. I know this is like a social media darling in a lot of ways. This is not the horse you want to get behind. If cybersecurity really is what you're focused on, focus on a stock that is thicker, that has real liquidity, that didn't go from 47 to 4, right? Focus on one of the big guys. There was like 15 major cybersecurity stocks out there. Focus on one of those. Don't focus on the IronNet, because this chart, I mean, just look at it. It just reeks of I don't want to say manipulation, because I don't know the intent, but come on, you got these random days here where the stock trades, 10 times its normal volume. It's not healthy. This is not normal. It's not normal. Okay.
Yeah, and my thoughts on this would be, I think there are some industries where you actually want to. It's a good idea to try to find some of the companies that are smaller, that are going to grow in and grab other companies' market shares. But in an industry like this, and I don't know exactly what IronNet does.
Me neither.
But assuming they're a competitor, just a cybersecurity play, that they're trying to get clients, and they'll, do company cybersecurity for them. If you're a company, why would you want to go with IronNet over a company like Fortinet or over a company like Palo Alto that's more established, right? If I'm paying someone to protect my assets that are online or my accounts, I'm going to pay the best of the best. So to me, this isn't an industry to try to pick one that is like a small dog trying to take more of the market share.
Yeah, totally agree. All right, so let's move away from that for a second, and let's preview the rest of today's show. We are going to talk about the
Warren Buffett,
the Berkshire Hathaway annual letter. I read it twice. I have thoughts. I have takeaways. We are going to have our first guest of the day on in like 6 minutes from now. It's going to be a good one. We're going to talk to Sean Richards from, he's an independent economist. His website is Not a Yes Man Economics. That's his website. And Sean has thoughts on the economic implications of the Russia-Ukraine conflict. He has thoughts on inflation. We'll get his thoughts on that. We're going to have Matt Hammond on the show for the first time in a few weeks now to talk IPOs. But also, I just want to know about his experience. Matt Hammond, if those wondering, is out of Ukraine now with his family. He is safe. And we'll get him on the show at 12:15 to talk about all of that and more. We're going to have Jake Wujastyk from TrendSpider on at 1 and Chris Capre from the Benzinga Options Trading School on at 1:30. That's the show for today.
Packed Monday. Go ahead and smash the like if you guys have not already.
A lot to get to.
Smash the like if you guys have not already.
A lot to get to.
Should we touch on Warren Buffett real quick before our first guess?
Yeah, yes.
All right, so you said you read it twice.
Yep. For those that don't know what I'm talking about, the Berkshire Hathaway annual letter is released annually. Obviously, it's once a year.
Not to be confused with the Berkshire annual shareholder meeting.
No, this is the precursor to that. So the annual shareholder meeting is 2 months. I think 2 months from today.
And you're going to that, correct?
I don't know, man. I really don't know. I have email notifications set for the flights because the flight situation is fluid. I'm putting the link in the chat if you don't know what I'm talking about to the actual letter itself. Honestly, everyone should read this. Warren Buffett is one of the best financial communicators of all time. He explains things in simple English, in plain English, and he's just such a folksy guy. He's just so folksy. Everything to him he makes it seem so obvious, like duh. Anyway, I have some thoughts on the letter, so I'm going to bring up a chart of Berkshire Hathaway as I talk about this. So the first thing I want to point out is if you open up the letter, the first page just shows Berkshire Hathaway's annual returns compared to the S&P 500. And, why don't I just pull up the letter? That's better. I'll pull up the letter and we can all go through this together at the same time.
So I saw that, and how does that work? Is that assuming you reinvest your dividends from Berk, or does Berkshire offer a dividend?
Yeah, it's taking dividends from both. So assuming you reinvested, it's a total return thing. Assuming you reinvested your dividends from Berkshire Hathaway and also with the S&P 500. So where's my link to the? Here we go. Okay, make it bigger so y'all can see what I'm looking at. Boom, annual letter right there on the screen. So the first thing I want to say is bottom of page 2 here. Berkshire Hathaway's annual return since 1965, the average amount it's gained per year has been double the S&P 500. If you bought the S&P 500 in 1965, you have gained an average of 10% per year. 10.5%.
What do the numbers in the parentheses mean?
That means it was a loss.
Oh,
right. So since
he was down 31. Oh, that was 08.
Yeah.
Okay.
Yeah, that was a great recession. So anyway, if you don't know why people worship Warren Buffett, this is why. Because since 1964, Berkshire Hathaway has increased in value 3.6 million % versus a 30,000% gain in the S&P. He has doubled the performance per year on average of the S&P 500. It just makes him a freaking beast. The other thing I was looking at is I was trying to find, when were his worst years? Not in terms of return, but in terms of the compared to the S&P 500. Okay, Warren Buffett, going back to to when he bought Berkshire Hathaway in 1965, Warren Buffett has underperformed the S&P 500 for 3 straight years, only one time. The S&P has beaten Warren Buffett 3 years in a row, one time since 1965. And that one time, it was actually 4 years in a row it happened. From 2002 to 2005. This period. This is the only period of time. This period right here is 02 to 06, right?
Well, I only see it 3 years in a row there.
No. Oh, I'm sorry. You're right. It's 03. Yeah, that's sorry. I can't read. 03 to 05, right? Was the only period where Warren Buffett did not do better than the overall market for 3 straight years. Isn't that amazing?
Yeah. Wow.
Every other period of underperformance of Buffett versus the S&P, it was he was
well, you can see some recent significant underperformance in 2019, 2020. I mean,
but it's 1 year or it's 2 years. He always eventually comes back. So
well, what I was going to say was this year he's actually caught. If you look at the SPY chart with the Berkshire chart since COVID hit,
yep.
for almost 2 years, the S&P 500 had way outperformed him. But with this recent, kind of inflow back to value,
Yep.
Berkshire has actually surpassed
SPY's return. I should note that this data is as of the end of last year. So,
okay.
Yeah. It doesn't include this year. But how amazing is that? To beat the overall market with the consistency that he does, it is mind-blowing. It is mind-blowing. So those are my first two takeaways here from the letter, is just his consistency over time, over the last 60 years is second to none. And that's what makes him the GOAT, or as Happy says, he's the Kobe Bryant of investing. And that's totally true. He's the Kobe Bryant plus the Michael Jordan plus everything. He's the GOAT. I have more takeaways, but I want to save them for after our guest here, because our guest is here right now. First guest of the day, as I said, Sean Richards is a freelance economist. He runs Not a Yes Man Economics, and he has thoughts, as I said, on this whole geopolitical mess we find ourselves in. So let's give Sean the special intro and get him on the show right now. Where's Russ? Sean, welcome to Benzinga Live.
Thank you. Thank you for having me on. And by the way, I saw the last bit and it's Michael Jordan for me.
Well, tomato. Michael Jordan. Yeah. Totally agree. Okay, Sean, let's just get your overall thoughts here on there's a lot of balls in the air, right? There is Russia and Ukraine. There's inflation. There's central bank policy here. But I want to start with the Russia-Ukraine situation. What are the potential economic implications of what is happening right now over there?
Well, in my opinion, what they're bringing is more of what we've got already. So, for example, you're seeing inflation in the US. We have it here in the UK. It's around Europe. It's everywhere you look. What have we got now? Higher oil prices, higher gas prices. A difference for us over here in Europe to yourselves there is that the domestic energy price situation is much, much worse. It's all across Europe. Prices are higher. So what is that driving? What used to be called stagflation. You both look too young to me to remember the periods whereby we really suffered from this.
Yes.
But we are in a phase whereby it's coming back again. And so economies are grinding down. Why are they grinding down? Why do I think that'll be worse? Well, the thing is, with the inflation, wages are unlikely to keep up. So as we go through 2022, we'll see that inflation drags the economy back as well. So I'm sorry, it's not a nice message, but that's where we are at the moment.
So just to be clear, you do think that stagflation is going to happen?
Yes.
Yeah, that's no fun.
It's a problem.
That opinion, though, is not shared by no opinion in the world of economics is shared by everyone. But that opinion is certainly not the majority, though. So what do you say to the counter argument that there won't be stagflation, that inflation, while elevated, it may not persist, and B, that the economy will not contract?
Well, I never said it would contract, but going back to, if we start with the inflation point, this was what everyone was saying in 2021, wasn't it? Or at least the central bankers. It was going to be transitory. It wasn't going to persist. You see, the other feature of these phases of time, it lasts for longer than you think. And we see a rolling through of areas where it applies. For example, looking at the US inflation numbers, one of the things that people are expecting to pick up is rent. Now, that's a very big part of how inflation is measured in the US. And your CPI shelters something like 32%. Similar trends here. So we see a rolling through from one area to the other. So we've seen energy. We've seen oil prices, for example, go higher with the Ukraine-Russia issue as well. So there's always extra pushes keeping it coming. So that's my argument on that side. For the actual economic growth, I never said an actual contraction, although some places are seeing it. What I mean is that we'll see slow growth, not the sort of growth that we hope for. Looking at, say, the US, you had a good end to last year. This year, the beginning of, is not looking so good.
All right, so I guess I should clarify, because stagflation just means that you have inflation with a slowing economy. It doesn't mean the economy necessarily has to shrink. It just means it has to grow more slowly. Now, let's just pretend you're right here for a minute. What is the solution? What is our way out of that? Because you can only fight one battle at a time.
Well, yes, and part of fighting the battle was something that should have been done last year, because you're seeing the Federal Reserve talking about raising interest rates in March. Bank of England has already had one go, expected to have some more, but that takes time to act. So when they were last year saying it was going to be transitory, to my point, they were putting their head in the sand, because these things, you've got to get ahead of the game rather than then trying to chase it as they are now. And here's maybe a piece of good news for you. I'm not expecting the interest rate rises that others are, because I think that as we go through the year, they'll see inflation, they'll see a slowing in the economy, and they'll think, and stop.
So if you were the czar of all the world central banks right now, what would you do?
What would I have done? I would have raised interest rates already. In terms of what I'm doing now, we'd get some more, and then I'd wait and see.
How much more? Like from zero, how much more?
Well, that's a really good question, actually. I think the starting point, if you're a central banker, would be to try and get interest rates up to 2%. You'll notice I said try, because I don't think it's going to be very easy.
Not easy because you can only really go a quarter to a half point at a time, or would you and then?
Well, I mean, you could do more. For example, I mean, this morning,
well,
the Bank
I
of
Mean,
Russia
in theory,
10.5.
Yeah, you could double your rate, yeah, if you really wanted to, but like let's just say a central bank that is not in the midst of a armed conflict right now, you really can't go more than a half at a time without shocking the market, right?
Well, yeah, but I don't think that your criteria really should be shocking the market. I mean, what would be wrong with saying, okay, I see an issue coming up. This could be the UK or US, more difficult for Europe in its position. We'll raise interest rates to 1%. That's going to be our move. Then we'll sit and wait and see how things develop, so that you're actually getting on with it. But you're rather than, I mean, what is the point? I don't see it. I see some firms predicting there'll be 7 rises in the US, 9 rises. What's the point of that? Why not get on with most of it and then say we'll wait and see what happens? Yeah,
that's certainly an argument to be made. But like, can you just recap for us, though? I mentioned the Russia-Ukraine situation. You mentioned the fact that the Russian central bank put their interest rate to 20% over the weekend from 10%. Can you just outline for us what sort of economic developments have happened over the weekend for Russia?
Okay, well, you see, this for them is essentially around their exchange rate. The ruble closed at 83 on Friday. When things started up again last night, it was at 106.
Oh, yeah.
So the word collapse is bandied about, but for once it maybe was genuinely used. And so they then felt they had to come in and stop it. But this is really awkward in terms of trying to do it with an interest rate, because even with what they've done, a 10% rise, that's 10% over the next year. Well, it's only roughly half what people were losing last night. So this is the problem you face. So as well, they'll be intervening. The Bank of Russia will be in. But again, it's very expensive. Russia has a lot of foreign exchange reserves. So that, from their point of view, is a good thing. But here's the next problem. Central banks around the world are trying to stop them using them. And some of their reserves are held at the Bank of England. Some are in New York. Some are in Frankfurt. Some are in Tokyo. And they're being blocked from that. So actually the amount they have to use at the minute is maybe only a quarter of the $630 billion that people thought they had. This is a new era and a new game. We haven't seen this before. It brings risks because, for example, leaping a long way ahead, Others might decide in future not to hold their stuff at the Bank of England and the Federal Reserve and so on. But for now, Russia's been very restricted. So there must have been panic, frankly, panic to say the least at the Bank of Russia. What can we do? So they've jacked up interest rates as something. They will be intervening, but they have much less. Now, why are they doing this? Well, everything in Russia has suddenly got a lot more expensive. We're talking about inflation for us, but for them, anything you from abroad has just shot up in price. This is quite a crunch. The ordinary Russian are not responsible for the war. I mean, the ordinary man on the street or woman on the street, but they're being hurt quite badly. And so that's why the central bank's stepping. That's why their stock market's closed today. Why? Because everyone will be selling. They're trying to hide the truth. So it's quite a complicated mixture there.
I mean, maybe as a general rule of thumb, if you're relying on your reserves in foreign banks, maybe just don't attack another country and then risk losing access to those reserves. And you mentioned the fact that the crash of the ruble is good for whatever assets that Russia has in other currencies, but that I think is more than counteracted by the fact that their own people are going to pay for this. Their own people are the ones that are going to suffer the most. And I think that more than that, I think that tilts the scales, away from whatever benefit, whatever hypothetical benefit that they have. The ruble collapsing is good for no one in Russia. So,
as I said, the ordinary person will be hurt quite badly by this.
Right, and that's maybe. I mean, that's the unfortunate part of this, is it's going to impact them the most. So you mentioned the fact that the Russian stock market is closed, the ruble is collapsing, the Russian banks have been expelled from the global SWIFT payment system. What is next here, Sean? As we sort of, in terms of just the economic reaction here, what is the next shoe to drop?
For example, some of the ways that Russia can respond, and already has, is by restricting this. In a way, things that, again, another venture that people hadn't thought of. Russia's a big producer of fertilizer, for example. Russia and Ukraine, between them, are big wheat producers. Now, I know it's slightly different emphasis for yourselves in the United States, because the US is too. But say for somewhere like the UK, that's a food importer, to some extent for wheat around a lot of Europe, this is difficult. And this is back to my original point about inflation. If fertilizer is going to be a lot more expensive, or you can't get hold of it, either perhaps food's going to be in short supply, or it's going to be a lot more expensive for this year's harvest. So these are the sort of other factors that are playing out. And in the way that, again, things that people hadn't really thought about, because we haven't seen this for a very long time.
Well, I also just would be curious, Sean. We know that the global economy is interconnected, right? So what's bad for one major world economy can also be bad for several major world economies. What are the chances of this? Russia, what they've done to their own economy in the span of 3 days. What are the chances that pain, spreads to other parts of Europe, and from there it can go anywhere?
I'm sure, because there'll be places nearby that are dependent on Russian business. Whilst the ordinary Russians quite poor, obviously they're the oligarchs. Now this is references somewhere near to me, because Chelsea in London is called Chelsea. The football team, soccer as you call it, is called the same.
Right.
Because there's so many Russians here. It is a thing, and a lot of wealthy money's come here. It's gone to other places, Cyprus, bits of Greece, and around the world. I'm sure there's some in America too, but all of these things are in place. Some of this will now stop. There'll be places that deal with Russia for business. Well, Russian companies and banks can't trade and pay, can they? So this will pop out in places we don't expect as well. That someone's trying. Lots of modern business and finance is complicated, and it relies on a lot of links in the chain. Well, if one of the links is a Russian bank, Russian business, and we've just shut it down. So these things will pop up where we don't think, and we don't know.
That's fun. That's always enjoyable. More unknowns. Sean Richards is a freelance economist, and his website is in the description of this video, notayesmaneconomics.com. Sean, we'll have to have you back as things develop here and talk more about this, because it's a moving target. 5 moving targets.
Yes. Thank you.
Thanks a lot, Sean. All right, let's go to our next guest, who can offer us a very different perspective on the situation. Matt Hammond. He runs IPOwarriors.com, and he, well, rather than me just say, I'll just bring him on right now, we can talk about it right now. Matt, what's up, man? How are we doing?
Oh man, it's been a pretty difficult week. It's been months of this kind of growing and building, and the stress and suspense has been more than just a distraction, but it really hit the fan last week. For those of you who don't know, me and my wife and my daughter, we live in Kiev, and for weeks the pressure's been building up. We've been getting, starting really on about January 23rd, but then I guess February 12th, the U.S. Embassy really started hammering out these warnings that, hey, U.S. citizens should be taking advantage of commercially available options for leaving the country, and that, to be safe, you should probably get out. It's an incredibly difficult decision to make that from the outside seems very easy. I mean, there might be a war, just leave. But when your wife is pregnant, she has hospitals that she really trusts, and you've already, committed to. You have your apartment that you spent however much time and money. I mean, yes, they're all material things, but it's so much easier to stay in place. It's so much easier to just hope that things work out. And it's really impossible to believe that this would happen. I mean, it's really as crazy as thinking that Detroit would get invaded by somebody. That, the idea that there would be a war zone outside of your window is unfathomable. And, there's so much just confirmation bias. Once you understand that you don't want that to happen, you start looking for clues like, oh, but, Russians and Ukrainians, they're both, former Soviet nations. They how many brothers and mothers and families, are just divided by a border. They would never come in and attack with bullets and missiles and bombs. And, this is the 21st century. We already put that kind of warfare behind us in, between developed nations. That just doesn't happen anymore. And the cognitive dissonance, that you just can't really accept it. And you don't want to pack all your stuff and find places for your dogs to be kept while you evacuate. You don't want to accept that. And it was really, on top of that, you had all the media in the Ukraine telling, they have to reduce panic. They don't want the whole country evacuating. They don't want everybody being, making a run on banks and a run on supermarkets. They want to keep people calm, and that's their responsibility to do that. So, we're getting a lot of information from inside the country that, no, things are okay. I mean, there's no way there's going to be war. Just everybody relax. This is all just, they're blaming American media and Western media for causing all this, hype and hysteria just to, to create news, to create destabilization in Ukraine. I mean, there's a million conspiracy theories going around, and it really got to the point where we got out less than 35 hours before the invasion started. And it really just sort of still sends shudders down my spine to think that, we're taking COVID tests in order to fly out. Now Poland has waived those, but when we flew out, they were in place. And, you think about, okay, well, if I fail my COVID test before a vacation, I have to cancel all my vacation. That'll be a huge pain in the ass. In this situation, it's like, if I fail my COVID test, I might end up in quarantine situations and stuck in a really bad situation. So we got out just in time. It's, we went to Warsaw first. Now we're in Lisbon, just in a hotel room. it's weird. It's a weird situation. You leave everything you couldn't take with you behind. We packed, not really knowing if we were just going to be leaving for a week or two, and everything would blow over, which is of course what we hoped. And now we know differently. The day after you left, or 2 days, we got to Warsaw at night, late at night. The next day we woke up and there's a lot of tension, but didn't know if we had made an unnecessarily, expensive anyway. From at the time it seems expensive to have packed up and left. And then the next day you're waking up to these just horrific images and friends still stuck there, people who were supposed to fly out on the 24th, having to turn around and having no food in their refrigerator. No, they had planned to be evacuated, and other people. I have friends who are in the subway stations, right? Guys I played basketball with, undoubtedly, grabbing, our neighbors are making Molotov cocktails. The windows in our apartment complex apparently have all been blown out. Our neighbors who did stay and are kind of like protecting against looters and, other.
I was going to ask you. I was going to ask you if you had any word on your apartment and how that has fared through all this, but it seems like you do.
Yeah, we don't have anyone who's gone in. At this point.
Yeah.
On one hand, it seems trivial to say, "Oh, well, our things." I'm just happy that we got out. But on the other hand, It's like, yeah, that is our. You build your, you have your thing, you have your stuff, especially for my wife and stuff. But yeah, we have a few very brave neighbors who are very appreciative too, who are literally living in the hallway because that's where it's safe to be. And it's a very, it's surreal. I mean, of the things, first it was COVID. It was like, I didn't think I'd ever see a global pandemic in my lifetime. That was crazy. Yeah. And now war, it's just sort of like, what,
I mean, I don't often, I don't ever frankly want to speak for this whole company, but I think I speak for this whole company when I say we are glad that you are safe and you made it out. Your timing was,
too
close, but I mean, I'm glad to see you made it out. Do you? I mean, I assume your wife has family in the area.
Yeah. So her brother and her mom are down, kind of in the to the south. They're not in an area that has been immediately impacted yet, which we're grateful for. We did. I mean, it's not the kind of thing you wanted to be right about. There's times when you're right, especially like we all trade stocks here. That's why we're here. And you're right. And you're like, yeah, it feels so great when you're right. This is not one of those I told you so moments that feels good at all. And we did encourage them to, get their visas ready, get ready to go, come with us. But we're talking, like I said, there was a lot of information and a lot of encouragement. Ukraine, I don't question the decision. Of course, I have a pregnant wife and a daughter, but Ukrainians feel that many Ukrainians feel the right thing to do was to stay and defend their country or stay in their apartments. It's an incredibly, it's been a pretty deep insight for me in terms of, we talk about risk management all the time, in trading, and there are parallels, but not to trivialize, the decisions that we've had to make here and that other people have had to make here. But, the things that you understand about the way people process information are that much more consequential in this type of situation. And there are parallels. We don't like to sell out of a losing position. We think that it'll get better. And the human psychology wants to believe that, no, it'll come back up. No, there'll be peace. No, this is, this is not going to be that bad if we just stay here. And then there's I think completely outside of that is, hey, no, this is my family, this is my homeland. I'm going to defend it. That's not a mentality that we should be bringing to the stock market, but it is a reality in this situation. And there was the reality that I had, margin calls and other things that everyone knows or who follows me knows that trading on margins dramatically changed my financial situation. It also means that in this kind of situation, I'm in the airport managing my portfolio, realize that, hey, actually I'm, expecting a huge spike downward drop off on Thursday morning, but actually war, as twisted as it is, tends to buoy the stock market. And knowing that allowed me to kind of hold tight in positions that rallied since then. And sometimes you need a distraction, and even to the extent that maybe people are feeling a bit guilty on profiting off of an event like this. The market doesn't care about you when it tanks. The market doesn't care about you when it goes up or down. And we all have, that's what we do. We trade, and we have to trade through these situations. There are opportunities there. There are opportunities to lose money if you don't react accordingly. There's opportunities to make money, and no, it's not significant. And I just, on Thursday and Friday, other than manage some stop losses and kind of recite to myself that and set some stink bids, pretty much just had to turn off and take care of, obviously my wife has been a lot. It's her country, it's her family, it's her, it's her place. So tending to her and my daughter, the people in Warsaw were incredibly kind to us. The people here in Lisbon have been unbelievably generous. And I think, there have been moments where I can't even share the stories because I'll start crying here on TV, where people have just been insanely supportive of us in ways that I didn't really foresee. And the global kind of rallying to the assistance of Ukraine, also a bit late, but pretty. I don't know. I'm overwhelmed with.
I mean, Matt, if anyone has a right to try to profit off this, it's someone like you that's had your entire life disrupted. So
I'm really just I'm not trading too much. I'm picking up a few positions here, and we can talk about. It has been a healthy distraction for me to get some work done. To do, I sent out the newsletter last week. I sent out the newsletter recapping the lack of activity, but posted some ideas for. And we can transition. It's okay, not to put all of your, you can't, it's unhealthy to just continue to, we have to take breaks from this. We took my daughter to the zoo in Warsaw, and she had a great time. We went out and did some sightseeing in Lisbon yesterday. We can't just sit here and watch the news, and, just the panic and the depression will eat away your soul. And trading is one of those things where you're just thinking of ideas, just kind of a little mental vacation from the, from what's been happening. So I sent out some ideas last night saying, IPOs often get hit pretty hard by any market condition. They're kind of like, the first position that people will exit from once there's no buyers. The shorts move in. There's algorithms. There's people who, it's their job to take advantage of these opportunities, and you have to, you're better off, trading in the market than just saying, nothing I can do. But we're looking at it. We saw a big drop off on Thursday morning. Most of it happened in the pre-market. People just kind of panic sold in the pre-market, and the bottom was almost the opening bell of Thursday. And we saw, some of the, we already covered all that stuff. We saw some pretty good opportunities in recent IPOs that dropped pretty hard. These are, in my opinion, solid companies. Most of them have exposure to military or cyber technology, but some of them have just been kind of companies that I like that took more of a hit than they probably deserved on, Thursday's market dip. And they've rebounded pretty strongly. One that I have traded many times, and I like the company. I just feel like they're exposed to this sort of, they've been lumped in with the bathwater of being, a recent IPO, a growth stock, tech, and this one, Sentinel One, dropped down as low as I think $31 or $32 on Thursday morning, which is just a screaming buy on this one. And even when I send it out on Sunday, it's up over 7% today, back up at around 40, 41. I think I have it here. Yeah, it's at 41.17. So one thing about trading IPOs, I've said this many times, is you're just studying what ultimately becomes another stock on the stock market. And if you do this over many years, you will have very intimate understanding of the movement of different stocks. And with Sentinel-1, for example, it's just, this was in my mental database as, hey, this is a security stock. This is a recent IPO. They have, they're a leader in cybersecurity. They've been stealing market share from some of the other entrenched players. And, with this kind of news that where all stocks sink, the ones that are most likely to rebound quickly are the ones that are actually strong companies that if there is, if people believe that, well, inflation is going to have to, the rate hikes are going to have to wait a little bit while this war situation gets resolved. And this had a huge rebound from 31 here up to 42. I said over the weekend, this is definitely one to watch. It's up. Okay, it was up as high as 7.5% today. Now it's up. So Sentinel-1, that's one that I like, especially with cyber attacks playing a critical role here. I just don't think the downside is that heavy, and the upside potential just traded up as high as $78 just 3 months ago. So I like this one. Another one, Skywater Technologies, IPO that pretty low float, got short hit, and had a good earnings report. They do semiconductors, which have military applications. Again, you see on Thursday it dipped down to about 9. It's been up as high as 11.87 there. Following IPOs, trading IPOs doesn't just have to be the debut trade. We can keep an eye on these for when there are market catalysts that affect the whole market. Recent IPOs seem to be particularly volatile. So that's why I like following them. I like trading them. I like knowing about what's doing what. MTech down to 144, up as high as these guys do semiconductors that are used in drones, in missiles, in video surveillance with AI built in. That's been a good one. Neurosense. This is just one that a lot of recent low float biotechs have gotten hammered. Shorts have started attacking them after their kind of day 2 spike. This one has a bunch of presentations in March, and I had been holding this one, but kind of had to exit my position to relieve some margin stress last week. But today, I called this out on Sunday. It opened pre-market today. It was down at around 165, 170, ran up to 268, up 30% today. So it was pretty spot on with that one. And then the one that I've always liked, Inspira Technologies, and this is just kind of an example of if you like a company if you like a company that has gone on some big spikes. I know that their biggest catalyst won't come until the end of the year when they anticipate getting FDA approval for their core device, and then further FDA approval early next year. When you have these kind of positions where it's a low float company, they've had some big spikes. I've loaded up a position. I've made 3 huge wins on this already, and this is nice. Before the news comes along, or what I expect the big news to come. These market dips are great times to add to any position that you like long term. You don't want to be buying long-term positions, of course, when the market's overheated and everything's way up. But you have these stocks in your mental portfolio. Where they're, what your entry points are. And when you see dips way down here, it's kind of like if you see this as sort of the fair value right now, and you have opportunities to buy in right here, this is when you kind of use that knowledge of recent IPOs that haven't really reached their ultimate potential catalyst. This is a great time to buy in here. The warrants are even, I believe, a better value for the long-term play. But that's what I'm looking to do with the IPO knowledge when there aren't IPOs to trade. When there aren't, there was no IPOs last week. Doesn't look like any this week. So that's what I've been doing, other than just kind of figuring out where to go next and what to do next. And
Matt, can you go back to that? Can you go back to that slide a few slides ago? The one that wasn't about like the first slide you had. Yeah, that one. Okay. This is the important. This is the big. This is way more important. Honestly,
It's
like,
interesting.
it goes for both. It goes for life and for trading.
And I can say that actually trading was, the skills or whatever, I don't even know if they're skills, it's just instincts that kind of came over the last year, and especially just seeing the market drop in the last 3 months from where it was at in November, December. Um, those are definitely things that I was thinking about. I was thinking like, hey, we don't know if anything bad is going to happen, but if something really bad happens, um, where would I rather be if I'm wrong? So if I'm wrong that that there's going to be an invasion, if there's no invasion, and I'm wrong that I left, is that okay? That's not that bad. I'm still okay. But if I stay and I'm wrong, I've put my family and myself in serious risk.
Yeah.
And which wrong would I rather endure? And if I'm right, I don't even want to be right. But if I am wrong, and some of the things that I had to kind of mentally process was because it's so different to be on the outside. It's so different to say, oh, I would have left if I were in that situation. You don't know that. It's really easy when all your whole life is not going to be uprooted. And it really is so much easier to do nothing. It was so much easier. I mean, even in January when we first started kind of really thinking like something might happen at any time, it was just so much easier to not pack all your stuff up, to not find some safe place like 9 hours drive away from Kiev where our dogs could stay while we figured things out. It's so much easier not to leave and pack everything, not knowing how long you're going to have to, leave. I mean, it's expensive to rent cars, to take flights, to rent places to stay, to be on sort of a forced, it's kind of a vacation, but doesn't feel like a normal vacation.
I bet.
And your mind will doubt, the extreme possibilities of war. I mean, I had a really hard time imagining what is currently the view from our window. I mean, we would be watching the sky burn, warplanes flying overhead. We have an expansive view from our, we're on the 16th floor. We look out over the river. We can see the left side of Kiev. I mean, we would be, other than the fact that our windows are probably blown out right now, witnessing like real warfare, like you see in the movies. That your mind doesn't expect that to happen. In confirmation bias, cognitive dissonance, these are two things I've always been very aware of, and even more so. Confirmation bias is that you tend to see things that confirm what you want to believe. And in the stock market, that's something like, oh, you just believe that this company is great, and doesn't matter what everyone else says, if the stock's going down or anything else, you just believe it, and you start doing research, and you find research that confirms what you believe. And that's very dangerous in a situation like this, where you want to believe that there's not going to be a war in your neighborhood. And so you start trying to justify, oh no, Putin's just doing military exercises. This is just the Western media, stirring up crap for political reasons. This isn't really going to happen. There's no way. And you find facts to back, that thing that you want to believe. Cognitive dissonance is another one to believe, is your brain doesn't want to accept things that aren't in alignment with the facts that are clear to everybody else. And even when I'm getting 3 calls a day from the embassy, and everybody on the outside, my friends, my family, people I haven't talked to in years, are sending me messages saying, Matt, you guys really should get out. This sounds crazy. There's and also
there's part of you that wants to. You're not here. You don't know. You just want to dismiss them out of hand. But
so again, weighing the worst case scenarios for all possible outcomes, that to me was really where it got to the point where it's just couldn't. It felt like I was staying in a burning building and having a really hard time just getting through to my wife that, look, this is really potentially terrible. And if I'm wrong, I hope I'm wrong. I really hope I'm wrong, but I'd rather be wrong in another, in a safe place than wrong and stuck in the war zone. And we did a lot. I mean, I can say that looking back, we really took precautions. Like I mean, amidst all this, we had a vacation within Ukraine travel, like scheduled for the 17th to the 21st, which coincidentally took us out of Kiev and into much safer kind of wait and see locations anyway. So we took that. But instead of leaving our dogs in Kiev, with our neighbors looking after them, knowing that, hey, if stuff happens, we don't want our dogs left in Kiev, we canceled our train. We were going to take a train out to where we're going. Instead, we rented a car so we could take our dogs with us. And now our dogs are at least in a much safer place to wait this out, and we can get them. They're much closer to the Polish and Hungarian borders, and it's kind of, it's maybe a weak analogy, but I've learned so much in the stock market recently about setting puts, or buying puts when you're up in a position, setting stop losses, doing things, and I do believe that all of that all those mental exercises helped me in this situation, because I was, I was thinking,
sure.
well, if this does happen, what are the things we can take? What are the precautions we can take to mitigate these? Someone asked me why we were in Lisbon. I've always liked Portugal. I've been here before. My wife's pregnant, and Warsaw was kind of cold. Portugal's a little bit more affordable than the rest of Europe if we're really kind of in a position where we have to hunker down for months or years. There's surfing here. I like surfing. It's near the ocean. So all things considered, once we got out, and the easiest way to get out was Warsaw, then it was kind of like, all right, so where do we go now? My wife's 5 months pregnant. We didn't want to fly all the way to America. It's also a long way to come back, and we didn't have our dogs, so we need to be somewhere kind of staged in Europe. And of all the places I've been, that it was a combination of cost, comfort, and where we could see ourselves actually settling in if this becomes a permanent kind of vacation.
Yeah.
So,
I don't even know what to say to all this, Matt. I mean, I literally can't even imagine what you're going through. So I
can't imagine. I'm still processing it. It's honestly like,
yeah.
there's times when we wake up and it's just like, where am I? And what's going on? What are we doing? Oh my God, we're in a country that a week ago. I mean, and then the other thing that it's only been, especially it was on Saturday when I was just like, we've been through so much between when it all started on Thursday to Saturday, to just be like, wow, it's only been 2 days. Like, oh my God. And like now it's only been 5 days? And it's just kind of like, wow, it feels like I've already left a war zone, been in Warsaw for a few days, and now had a few days in Lisbon. It's just like, wow, this is still unfolding. I really hope that somehow they can get through to Putin, and he starts processing that this was a huge blunder. This all blows up in his face, and he like takes the easiest off ramp possible, and not do something insane like double down and say, this could still get scarier here. And it's it feels good to get out, but nothing about the situation feels good. So.
Yeah, thank you for coming on today, Matt. We've been in communication via email. You were kind enough to let us know when you were out. But really interesting here how trading has taught, the thought process of trading has helped you in this situation that is entirely out of your control, and yet you've been able to navigate it in part because of your experience and understanding thought process and managing risk. So I think that's a big takeaway here.
Yeah, I think in a lot of professional, a lot of decisions in life, you don't have to think about risk.
Yep.
I think when you're in a job where you're mostly producing things, or you're not having to, in a very calculated way, identify what you're doing to, because I think most people start out trading not thinking about puts, not thinking about selling covered calls, not thinking about stop losses. They just buy low, sell high. That's kind of where we all start. And as you do things longer and you get more sophisticated and understand more of the tools, you realize that it's much less about, like, long-term success is much less about taking profits than avoiding losing money while actively trading. And if you can actively trade without losing money, the default to that is that you will be profitable over time. But yeah, having those kind of mental tools and being aware of how my mind was working definitely helped make the tough decision. I mean, it was
and also the art of changing your mind, the art of knowing how to quickly change your mind. Admit you're wrong, change your mind, do something about it, right?
There's no victory in remaining on the losing side of a decision.
Right. For sure. Matt, we appreciate you so much for coming on today. I wasn't quite sure how this segment was going to go, but I thank you for joining us, for letting us know that you're safe, and I guess all I can say is I hope you're able to return home sooner rather than later. I think we all hope that.
Spencer. Thanks to everybody. I mean, everybody out there. I mean, I'm leaving people out here, but Aaron, Mitch, Luke, you, everybody in Benzinga has been emailing me, asking me if everything's okay, if there's anything they can do to help. I mean, the support of this community, the IPO Warriors community, I've gotten a lot of support from them. So, thanks to everybody. Really appreciate it. It's been humbling, and it's just another reminder to kiss your loved ones while you're in a position to, and enjoy your life while you can. There are things way more important than money and the stock market and everything else, and things can change so much faster than you think they can, and take advantage of the good things while you can.
And hey, Natalie Stone points out that Lisbon's good for crypto, so there's a silver lining here after all. Matt, thanks for coming on Benzinga Live today. Stay safe out there. All right, Matt. All right. I don't know how we move on from that segment. Frankly, that was like the best segment we've ever had on this show, I think. I don't even know if I want to talk about other stuff today because gosh. I mean, and this is why on Thursday I was on pre-market prep, and I was just freaking bummed and just upset. Because the shit kind of hit the fan on Wednesday night, Thursday morning, and I was just like, who wants to talk about the stock market right now? Now I've had a few days to come to grips with the situation, and obviously this doesn't affect me like it affects Matt, but it's hard to focus on other things, and at the same time, as Matt said, you need a distraction. So sometimes maybe the focusing on the market can be good because it can just distract you from other things. But I don't really want to talk about World War III possibilities, Sam. I'll be honest with you. I mean,
there were a lot of great takeaways from that chat with Matt. Like Matt said, though, I mean, the market doesn't care about you. It doesn't care about
and the world. The world likewise doesn't care about you. I mean, the Russian army does not care about Matt, right? That was a great segment, man. I mean, the art of changing your mind in risk analysis, risk management. I mean, that's real risk management right there. Forget buying puts. That's real risk management. So,
speaking of buying puts, it does seem like in the past, hour. Since we've started the show, really, the markets have kind of turned around. We were positive in pretty much all major, or at least SPY and NASDAQ were positive when we started the show. Now they've given up some of their gains. Looking at some big movers. Spencer, we talked about this last week. It was toward the end of the week. I forget exactly what day it was, but it was a day where the Qs were up like 1.5%. All of tech was up, and Netflix was actually red. You recall that?
No, we talked about that.
Yeah. That's what I said.
Oh, yeah.
We talked about that last week.
Yeah.
I was watching Netflix today. It looked like Netflix actually broke out a little bit. I mean, it was up like 1.5% when the rest of the market, or when NASDAQ was up like 0.5%. I don't know. I mean, like, on one end, that's a red flag for me, right? That a stock is not performing well in an environment where like other tech stocks are doing well. But on the other hand, you have to imagine that there will be a reversion to the mean, and that Netflix will then catch up. It's such a big name, so I see both sides of it. I'm just watching Netflix right now. I'll say that I'm officially watching it. I think either if we get back down to the level around 350 that we saw to, I mean, this stock after that terrible earnings report ran from 350 to 450, but since then we've kind of been hanging out in this 380 to 400 level. I'd be looking for that next run up to 450. I'm just not ready to play that yet. All
right, Netflix on the watch list. Let me go back to the Berkshire Hathaway letter, and then we can we're gonna have Jake Wujastyk join us in 10 minutes here from TrendSpider. So let's get my my letter back on the screen, and I will scroll. Actually, no, I don't need to bring that up. What I do want to bring up is the chart of Berkshire Hathaway, and I want to move on to some other takeaways I had. We talked about the annual returns of Berkshire as it pertains to the overall market, or as it compares to the overall market, the S&P 500. The fact that he's beaten it pretty consistently for 60 years is nothing short of remarkable. The biggest takeaway, though, from this letter in particular was what Warren Buffett called the 4 pillars of Berkshire Hathaway. For years, he's talked about the 3 pillars of Berkshire Hathaway. You have transportation, insurance, and energy.
Apple.
You can't ignore the apple in the room. The apple is one of the 4 pillars now of this company. Berkshire Hathaway owns 5.55% of Apple. And Apple itself accounts for about 40% of Berkshire Hathaway's public holdings. So Berkshire Hathaway holds, hundreds of companies. There are some companies where they own the entire thing, like Geico, and there are others where they only own pieces of via their just via the public markets, the stock market, and of the public market side of their business, Apple accounts for 40% of their portfolio. That's a lot. That's big time.
Yeah, and he noted, or I don't know if it was him, but Berkshire noted in the letter that year over year their stake in Apple increased from like 5.4 to 5.5, which they're like doesn't sound like a lot, but that 0.01% accounted for more than $100 million in earnings.
Yeah, each 0.1% increase in their Apple stake accounts for $100 million of Apple earnings.
Yeah, I mean, just incredible. But I guess to my question to that would be, and you can look up Berkshire's holdings, you can see what they're, and then when you're looking at the holdings, you can see what they're highly convicted on, because what they have more equity in. You could assume they're more bullish, more highly convicted in it. I mean, why would I? I mean, I get you get other exposure to stuff, but at that point, why wouldn't I just go out and buy Apple and buy some of the other holdings they have in there? Kraft Heinz or whatever it is.
Yeah, well, so maybe I should bring up the page you're talking about, which I think is page 6 in the letter, where the table that shows, okay, these are the companies. These are just a selection of companies that we own, and here's how much of it that we own.
I mean, maybe the answer to my question is just that you also get exposure to Geico.
Well, right. Well, yes. The answer to your question, which is why not just go and buy Apple.
Or I'm saying
or why not just go buy American Express?
Go buy the stocks that he owns, but then also, I'm saying, like, if I were doing that, I would put a lot of it in Apple, just because it's like, if Warren's that highly convicted in Apple, I'm that. I want most of my allocation to be toward Apple too.
Yeah, the answer to your question is the private company side and the management of Warren Buffett. But for example, so what this table shows is they own 20% of American Express. They own about 13% of Bank of America. They own 13% of Moody's. They own 9% of Coke. So they've got some large stakes, but again, in terms of the Berkshire portfolio, 40% of their portfolio is Apple, which is pretty stunning. Another takeaway I had here from the letter: Berkshire Hathaway has a lot of cash on their balance sheet, like an abnormally large amount of cash for them.
Yeah, they're ready to buy a dip if World War III breaks out and the stock market crashes. Berkshire will be in a good position to lower their cost average in Apple.
Berkshire Hathaway has $144 billion of cash and cash equivalents, which is just short-term bonds, on their balance sheet.
You know who else has a lot of cash?
No.
Apple.
Yes, that's true. So it is remarkable. He said in the letter, Buffett did, that they have always pledged, him and his partner Charlie Munger, they've always pledged to have more than $30 billion in cash at all times. Well, they have $144 billion, so just a little bit more than that.
That's my rule of thumb too. I always try to keep at least $30 billion in cash, just in case anything happens.
And my last takeaway here was just part of the Berkshire Hathaway story. Just speaks to the power of the stock buyback. In the last 2 years, Berkshire Hathaway has been buying back their stock. As a result of their buybacks, if you owned Berkshire Hathaway stock in say summer 2019 to today, your stake in Berkshire Hathaway in the company has increased 10%. You own 10% more Berkshire Hathaway today than you did 2 years ago. And the only thing that's changed is they've bought their own stock back. They've reduced the supply of their own stock in the public markets.
Spencer, I haven't looked too far into this, but I did see a headline earlier saying they were reducing their buybacks.
I didn't. That's possible. I didn't see that.
Let me fact check this real quick.
But your ownership stake has increased 10% in the last 2 years, all because Berkshire Hathaway's bought back their own stock. They have bought back about $51.7 billion of their own stock since the end of 2019.
Yeah, so this is a Barron's headline. Berkshire Hathaway's reduced buybacks may overshadow powerful earnings gains. The reduced buybacks of $1.2 billion in 2022, below the quarterly pace of nearly $7 billion. So I guess they just hadn't bought back.
He talked about the buyback is only good as a tool if your stock is undervalued. You don't want to buy your stock back when it's at ridiculous prices.
Yeah, if you're doing share buybacks while your stock's overvalued, you're diminishing returns
right.
Right.
So if you look at the chart of Berkshire Hathaway, let me bring it up on the screen here. You can see why they would want to buy back their stock less than they were before, because the stock has been on a huge run. So let me just go zoom out there. Look at the run that Berkshire has had. Look at that. Look at that performance. So it makes sense that they would lower their buyback rate. Stock is outperformed. Alabama Cowboy, you should email us.
I already.
Power Hour, or you can email just support@benzinga.com.
He already emailed them.
I'm
responding to it right now.
All right. Good deal. Alabama Cowboy, if you want to get your money back, you should be able to get your money back. It goes to show. I mean, we're not going to keep your money unless you give it to us forever, in which case we will. Yeah, exactly right. Parte Bonza is the transportation thing. Tariq, I put the link in the chat, but I'll put it in there again. Tariq, this is publicly available. It's on the Berkshire Hathaway website. Here's the link in the chat right now. That link, that's the link to Warren Buffett's annual letter. And I'll do you one better, actually. I'll do you one better. I will give you the link. I have to track it down for a second. I will give you the link to all of his letters. They are all great reads. They're not very long. I'll be honest, guys. This one was like 11 pages, and the text is nice and big. They're not very long letters. Gosh, I have to find the link, though. You may have to give me a few minutes to track it down, because I know where to find it. I just don't know how to find it. Does that make sense? That doesn't make sense at all. I'll track it down in a few minutes. But Warren, the archive of all of his letters is a fantastic read. I'll track it down at some point before the end of the show today. I promise.
Ooh, are the markets coming back in here? A little bit. All right,
I found it. That wasn't very hard. Google.
Okay, and then Spencer, when Jake hops on, I will have to leave for a second.
Google is your friend. Ready? I'm putting the link in the chat right now. That link goes to every single annual letter going back to 1977. And again, they're just really easy reads. They're nice. It's 10 pages, big font, easy sentences to understand, very big Very easy reads, very good reads. So, all right, let's move off of that for a minute. I had some more things to discuss with y'all, but we got to put that on hold for now because our next guest is here, Jake Wujastyk from TrendSpider, sharing the charts and the knowledge with us right now. Let's get Jake Wujastyk on the show. Let's give him our new intro as well, provided that I can find it. Jake, how are we doing out there?
It's going. It is going. How are you guys doing?
We're doing, man. We're doing. We're just trying to keep our heads above water over here. Drowning in news over the weekend, which is never a great thing to do. So, good to step away every so often and just clear your head. But I would be curious to get your thoughts on this because feelings are one thing, but you like to let the charts rule everything for you, the price rule everything for you. I would love to get where's your head at right now as far as the market's reaction these last 3-4 days?
Yeah, I mean, first and foremost, what's happening, in Ukraine is just absolutely devastating, and it's really tough to even focus on the markets when you've got people fighting for their lives essentially, and it just shows that money is it's not everything. But what I've just been trying to do is just kind of look at the key levels that I always look at that have held pretty well over the last week or actually a month or so. And so, especially when you've got price action like this, you literally could have news come out in 30 minutes and wipe out any setup on the long or short side. So, I mean, with this type of price action, I mean, you got to be literally trading like the 5-minute chart. But there are longer term setups that are still holding. So like SPY, for example, you do have a relatively strong candle last week, but the thing is I think last week was just a pretty big short squeeze into the end of the week. You had people liquidating their positions going into the end of the week, and a lot of those seem to be on the short side. And today you did have an initial little pop there, and then I think we pulled back simply because there was really nothing that came out of the meeting between Ukraine and Russia, which isn't shocking. And so now I think the markets in general are just trying to figure out what to do. Even your safe havens, your silvers and your golds aren't doing what I think a lot of people thought they would. I think Bitcoin's been kind of the interesting one, being up so much today, but at the same time, I think a lot of people there's demand for crypto right now because that's kind of the only way some people can get any money into Russia and that type of thing. So not shocking there. You've actually seen a pretty decent disconnect between the markets and Bitcoin over the last few days, or at least today with Bitcoin ripping and then the market kind of pulling back a little bit after its initial move up. But I mean, on the weekly chart, you can see here the main area that I'm watching here is essentially your capitulation, your low before the election in 2020. And the reason why I'm using that is essentially because it's been a really strong area that price has held. And what I've done is I've added an offset here. So this is something I've talked about a few times on the show. Essentially, an offset is it's having an original VWAP. So I'll take it off for a second. Here's your original VWAP. This is your volume weighted average price. This is essentially the dollar cost average of every share traded since the pre-election low capitulation. And you'll see that we bounced around that area. I mean, we talk about zones all the time when I come on Mondays, but this is, I mean, you may need to add a couple more percent to your zones when you're looking at this price action because people are very emotional. People are panicking. People are getting potentially margin calls if they're in the wrong type of asset. Look at some of the assets connected to and currencies connected to Russia. So a lot of this is based on liquidity and emotion. And when you've got those two things driving the markets, you need a lot of margin of error around the areas you're watching. So for me, this line has not necessarily been incredibly relevant over the last 2 years or year and a half. But what is relevant is about a 2.5% offset from that line. So essentially a margin of error about 2%, 2.5% above this line. So when I do that and I add that to the chart, you'll see here that this area becomes actually very relevant. You've got all of this price action literally for, months. The price was just riding up along this 2.5% offset. So if you guys want a better visual without this arrow, we'll just make it a really thick, we'll make it green. So you guys will see this is that offset. And we've literally we were riding along it for, the first quarter of 2021. And then we started to kind of take off and move up pretty quick off that area. But then as we pulled back over the last several weeks and even 2 months or so or more, we have found I don't even know if I want to call them buyers, but we've had supply dry up there at least around this zone. So for now, we're holding here, and this is the last day of the month. So you always want to kind of look at what's going on the monthly the monthly candle. And you have a decent wick here on this candle. Now, when you start talking about nuclear war and all types of stuff, I don't think charts are going to. That's unprecedented, right? You haven't seen that kind of price action in ever, pretty much. Mm-hmm. So if I were to just look at the chart and assume that things won't get that crazy, and maybe this will just be hopefully a war that's not just absolutely devastating. It already is, but to the point where we're getting Poland involved and all these other countries, the charts are going to not be as relevant as they were. Now, the one thing I will say is the fact that all this is happening is really lowering the probability of a high amount of interest rate hikes this year. I think that's what the market's pricing in, and people are wondering, well, why isn't the market tanking today? Because Putin mentioned a nuclear war, potential high alert on nuclear force. That's because there's nowhere else to put your money, especially when there is no. I would be shocked if they started hiking rates in this type of environment. You've already got prices, going out of control from oil to wheat, all that type of thing. So the market cares more about where is liquidity going. And if there's nowhere to put your money and get a yield, it's going to likely stay in the market, especially, the S&P 500. But you've even seen some growth names catch a bid, because if interest rates are going to remain zero, then all these growth names have been tanking the last 3 months because the market is anticipating 6-7 rate hikes within the year, and all of a sudden that pulls back, and that's why we're seeing these beaten down stocks actually not continuing down. And so I think a lot of people don't, or maybe people just don't fully understand how that works. But I have seen a lot of people saying, "Oh yeah, last night they're looking at futures and they're saying, well, PayPal is going to be at 95 again." Well, that's just not how it works. It's where liquidity goes. And when you have the market pricing in a less likely chance of interest rates really being hiked this year, then that money is going to flow into these names that have been getting hit because the market is anticipating rates going up. So all in all, I mean, it's not something that I can even really, and I think we talked about this like 2 weeks ago. I was like, I have no idea, or maybe it was on a Spaces I was on. Someone's asking me, well, what do you think is going to happen next week? And this is before Russia even invaded. So I'm like, yeah, I have no idea. This guy's crazy. Like, I have no idea what he's going to do. So I'm not even going to sit here and try to make it seem like I have any idea what's going to happen. Things can switch overnight so quickly, and people saw that last night. Futures were down 2.5%. All of a sudden, we went green for the day. If you're not trading futures, don't look at them, because if you're going to bed at night, happy that the market's down 2.5% because you have puts, people woke up this morning not as happy, and because the market pretty much does opposite what a lot of people think. So the S&P 500, the Qs, all of these things are going to be the same. I mean, if you want levels, like just general levels, if you're playing the if-then game, if we break this, then we go here. The levels are the same. And the thing is, last week's candle is the range on this candle is insane. So for me to come in and say, oh, what areas are there to look at? I mean, if I were to take a wild guess, I'd take this wick from late January, the bottom of this wick. I'd take this area here. And if we start to break down below the open and pretty much the previous week's low, if we break 431 on the weekly, then we could potentially go and test this previous low here, which is around 421, 422. But that's all an if-then statement, right? I mean, that's all you can do here. And notice here, this week's high so far is essentially last week's high. So we are trading within these thresholds of if this breaks, then that. We didn't break this, so then we're not going to look at anything higher at the moment. So if you're a horizontal trader, this is about all you can do right now. You can look at the previous high. You can see that we were rejected right at it. This is an area where we had a previous low in the week of February 14th. We opened here last week, which is also relevant. And now we're literally, we opened this week right at that area. So the 431.50, if we break down through that with some heavy selling in volume, then I think you're probably going to retest these lows around 420, which is just a psychological number.
There's a lot of good thoughts. There. Yes, I agree with your take on the futures markets. Unless you're actively trading them, although I'm a hypocrite because I am not actively trading them, but yet I watch them all the time. Probably not good for your psyche to be doing that. The rebound in tech today is interesting. I mean, you noted Bitcoin. Bitcoin is moving pretty correlated with tech, with the Qs, right? With Apple, with those types of assets. So let's bring up one. Oh, this is Bitcoin now. Great. So let's just look at Bitcoin here.
Yeah, and I think I think Bitcoin's deviating from the market, and that's something you haven't seen for a while. Bitcoin's up pretty big right now for the week, and the markets are kind of pulling back. So I think this is a function of essentially demand increasing because all of a sudden you've got people that want to transfer money to Russia, even companies that are maybe trying to pay their employees who are in Russia, but they're in the States or somewhere else. The only way to really do that right now, or one of the very few ways, is to transfer Bitcoin. So the demand of Bitcoin, I think, is just picking up, and that's why you're seeing the price. I don't think this is a representation of what it has been recently, which is a risk on, risk off sentiment liquidity gauge. I think now you're actually seeing Bitcoin being used with utility to actually get money to people, and that's why it's going up. This is not, at this point at least, this isn't a risk on, risk off indicator at the moment. It's actually people are utilizing it for what it really was created for. And so that's something I would maybe change a little bit moving forward. Like, I'm not going to look at Bitcoin and say, oh, Bitcoin's ripping, the market's going to do great. Bitcoin's ripping because there's a lot of demand for it right now because people are trying to figure out how the hell they're going to get paid in Russia from another country.
Right. All right, guys, if you have any tickers you want Jake to look at, drop them in the chat. He hangs out every Monday for 20 to 30 minutes and just runs through the market. So are there any, Jake, last week I was like, and this is Thursday when I was feeling super depressed and down, but I was like, I don't want any part of any short-term longs right now. Now that I've had a few days to mentally adjust, I don't quite know where I stand on that front, but do you have any short to intermediate term swings you want to tell us about?
Yeah, and one thing I'll mention, you call me not a true trader, whatever, I don't really care, but it's, for me, there's no way I could try to short this market right now. I don't want to wake up and hear that some massive, escalation happened with NATO and Russia, and I'm happy because I'm making money. I can't sleep at night knowing that I'm making money because of some people dying or something like that. So I'd rather just hold cash and make money on the long side. I just can't, because even if you don't think that way, but you have a put or a short in the market, you naturally all of a sudden are almost cheering on negativity throughout the world because of whatever, because of what's going on. So for me, I just can't do that. It's not within my just way I think. And but I wouldn't judge anyone for doing that. Just for me personally, I can't really do that. So like, if you did want to look at potential longs, Bitcoin, look at Bitcoin. Bitcoin continues to rip. So the first thing you would think about is maybe proxies to Bitcoin on the long side. So Mara is kind of one of the first things that I think about when I think of Bitcoin and a proxy, essentially. So, this thing hasn't even really been moving as much as you really would expect it. I think people probably will definitely continue to use this as a proxy. And who cares what? I don't even know what they do. I think they mine, but I don't even know. So I posted a chart of them a month ago, and someone's like, "Oh, this isn't really the best Bitcoin stock." Well, I don't care. What I care about is what do people think of when they think of Bitcoin stocks. That's where the liquidity comes from, not what's the best one. So Mara is definitely known, especially on Finchwood, as being that Bitcoin proxy. So if you were to think about maybe going long on something and you don't want to actually buy Bitcoin through a crypto exchange and you want to stay on the equity side of things, this may be a proxy to look at. So that's one. Or you could just straight up trade the crypto side of things. Ethereum, is pretty much looking pretty good here too. The only thing you'd want to really look for is a break through this diagonal resistance zone. So this diagonal resistance zone would be your first level, and that's probably around 3,000. It's also a psychological level, but then you just throw on a horizontal resistance line here, and I would just take it from here to here. Notice that I'm kind of taking these where we closed and where we opened in early February. I'm using that as my main line, but then I'm also using this margin of error to capture these two lower highs here. So that's kind of how I come up with price targets. So if we break through 3,000, then my target above would just be the previous highs in that zone, right around 3,250 or so. So far a pretty strong candle, but we'll see how it plays out into the rest of the day. SDC is one that I actually took a position in. Yeah, and I'll kind of explain my reasoning for that. One, I've been trading options over the last couple of weeks. I was in PayPal calls last week that did pretty well. I was in MU calls that didn't do so well. But the problem with any individual option, right? Any individual stocks options chain right now, unless you're trading like Tesla or you're trading, something that has a ton of liquidity, it's really hard to trade any individual names right now because the options chains are just so illiquid. The spreads are large. So this is one that I'm actually interested in because one, it's been absolutely annihilated because of that growth sell-off, and this has kind of been definitely a poster child of growth here. But a couple things. You've got this base forming, you've got this rounded base, you've got a gap above. Now, the only problem is you've got earnings tomorrow. So this is definitely going to be a make or break with earnings. So if you did enter this position, it'd be purely a gamble going into, I think it's after hours they have earnings. But I do like the base here. So if we were to use the weekly side of things, and we just simply look at where's a lot of volume kind of taken place since this high that we saw back in January of 2021, you'll see there is a ton of volume holding at this general area. And notice here that you've only got 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks of price action here, and you can see how much volume is holding. The next area is up here in the 550s, 560s. However, what you don't have is you don't have any volume up here. So if this thing really starts to break, and especially if it breaks these previous highs here from earnings, then you will probably see a pretty big move through this volume gap. Now, this reminds me a lot of 2008, 2009, when I was just trading the crappiest of crap companies that got destroyed. But the reason is you have these individual names, and this goes back to the saying of it's a market of stocks. It's not a stock
market.
Because there are individual names that are performing even today on the long side, even though the market's having trouble on the staying green. So what happens is you essentially have all of this capital that's sitting on the sidelines because they don't want to play the overall markets, and that money funnels into these individual names, especially these smaller cap names. I think this is like $850 million, so it's not anywhere near a micro cap, but it's definitely a smaller cap name. And same thing, right? I'd rather play common stock positions right now than have to deal with one, you got to deal with the VIX. If you're trading options, you have to look at the VIX. If the VIX is tanking and your stock is like maybe marginally going up, but it's going up, you may be like, if you're trading options and you're playing the long side, let's say the market absolutely rips into the rest of the week and the VIX just tanks. Let's say the VIX has like a negative 20% day. Your stock is really going to have to move up very quickly, kind of like an impulse move. If your stock is just slowly moving up while the VIX is tanking, that's going to hurt your premiums. So I personally, there's too many variables going on to play options right now, and I don't have enough time to be day trading, 0 today expiration or 2 days till expiration calls. And it's just, if I'm going to trade that type of contract, I'm going to be trading such a small amount of money. It's not worth my time to be distracted with other things. By other things. So for me, I'd rather just play common stock trades right now if I'm going to trade them at all. This is one, as I mentioned, this could easily break down. And that's the thing. This is a huge risk. But after some of the after some of the options trades I've taken over the last couple of weeks, even a common stock drawdown of 10% or 20% is going to be like, 10 minutes in the options market. So I'm willing to take this. You do have a bearish pennant forming. So maybe if you did take a long position, you buy some puts or something for downside protection. But the thing I like, though, is just one, you've got the setup. You've got a lot of volume supporting price here. Two, if you look at I use shortsqueeze.com. It's kind of the one that I go for just, where's stocks that have a huge percent short of the float. This has a 33.5% short percent of the float as of, I think, February 8th. So, who knows what that is now? But if you think about it, if February 8th, this was the week of February 8th, we actually had a pretty green start to that week. But if we continue to move down over the last 3 weeks, that short percent of the float actually may be higher. So if you do have a big move to the upside, because there's like a Snapchat type of earnings move or something like that. This isn't a huge company. It can happen, especially when you do have a lot of that artificial buying that will have to happen. What I mean by artificial buying is shorts having to cover. Those aren't true buyers. They're not buying the stock because they think it's going to go up. They're buying the stock because they have to get out, essentially get liquidated. So that's one that I've got my eye on. It's actually holding relatively well considering the crazy market right now. MU is another one that I trade pretty often, but at the same time, I cannot stand even looking to take a trade whenever you gap down into a previous wick. So the weekly candle, obviously, we've only been open for like half of a day for the weekly candle, but this is like a no touch for me. And even though the monthly looks good, right? Like look at the monthly, you got a decent ascending triangle setup here. The question is, what is this monthly candle going to actually close at the end of the day? Who knows? We could have news in 30 minutes that NATO's about to, start joining Ukraine. It's just so random right now. And if you are trading, there is a little bit of, a gambling mentality you'd probably have to go with right now, unless, as I mentioned, you're trading the 5 minute and you're staying very, very disciplined with, 5 minute rip, I'm taking my profits, I'm getting out. But past that, 5 minutes is a long time in today's world. I mean, 2 days over the weekend, look at how much stuff happened.
I know,
So-
man. I know.
So here, MU is maybe one. I'm looking at the monthly, but the weekly looks horrible.
And it's good. It's a good point to make that today is obviously the last day of the month. So we're going to get the close of today is going to be more important than a typical close, only because you get monthly candles, and for a lot of longer term minded people, the monthly candles are more important. So maybe it's not to say that the close today will be extra volatile, but it'll just have more meaning.
Yeah.
Right.
Yeah, and just from kind of like past experience, and it goes on both sides, right? If you gap into a wick, gap down or gap into wick, you are more likely to test at least the bottom of that candle's range than you are to move up. Same thing here. If we gapped up into this wick up here, I would expect at least a retest of last week's high. Here, since we gapped into the wick below last week's close and even the open, it's just not, it's like playing blackjack. It's just not a high probability hand, for me. So, and options, right? Like options are so illiquid right now. Even MU, which is generally pretty liquid, just and the thing is, if you're trading like Friday's expiration or next week's expiration, or maybe March's monthly expiration, which is literally in 2.5 weeks or whatever it is, that's where you can get some liquidity. But one, I mean, those contracts are really cheap. You're gonna have to buy a lot of contracts to get any type of decent sized position in there, and then all of a sudden you start looking at the volume to what the size of the position just bought. You're like, holy crap, I'm like 20% of the volume. So there's just not enough liquidity right now for me to have much conviction on the option side of things.
All right, we got a couple minutes left. Let's just do a couple of tickers from the chat. Someone asked about, well, you already covered Micron. You want to cover NVIDIA? I mean, you already covered Micron.
Yeah,
NVIDIA.
They kind of move relatively similar. So NVIDIA, I mean, not a horrible setup here on the weekly. The thing is, with this market, almost every candle is going to look the same, right? This hammer looks very similar to SPY, IWM, the Qs. It's just the market is moving in tandem right now. So if I were to draw like a basic area of resistance that I would look for to get through, it would just be this zone right here. So you can see here, if we did break above, let's say around 260, let's say just 255 to 260. If we closed above that area, possibly a further break to the upside. But notice here, if we do create a VWAP from this high, which it was in late November, right above that resistance zone, you have this VWAP here right around 270, which if you look at price action, just shown by this, I'll make the arrow bigger so everybody can follow. This has been a very important area to get through. 1, 2, 3, 4, 5. 5 times that we could not break above that, at least in December. So this is going to be a pretty crucial area to break above. So on the long side, at least, maybe for a continuation higher, I'd want to see a weekly close over 270. And then for the short side of things, if you were looking for a breakdown, and that's the thing, these wicks are so big. I mean, it would be really hard for me to even play the short side here, because your trigger technically is way down here at like 208. And by that point, you've already gone from 240 to 208. So if you wanted to maybe do kind of what we did on SPY earlier, this is an area that has had a pretty significant meaning. So January 31st, your low from that candle is right around 230. The week of February 14th, give or take, $1 is right around 230. Our open last week was right around 230. 230 is a psychological level in general. So if we break 230, that would probably be a trigger on the short side. And then a trigger on the long side would probably just be a break above this week's high. So notice here, same thing. You've got kind of these general areas that have opened and closed right around 245. 245 is kind of I was going to say an even number. It's not an even number, but it's a whole number, right? 245 is a level that a lot of people just think of as like, once you break 240, then 245 is probably the next increment to look at. So if we broke and closed above 245 on the daily, that'd probably be a trigger to retest this 255 to 260. If we break below 230, then you may look at a retest of this previous low around 208.
All right, Jake Wujastyk, co-founder of TrendSpider. Guys, the link to TrendSpider is in the description. You can also get 25% off with the code that's on the screen, BZ25. Jake, always a pleasure, man. Thanks for coming on. We'll talk to you again next week when we have a new monthly candle.
Sounds good. Have a good one, guys.
All right. AB.
Yes, sir.
It is 1:30.
You know what time it is.
I do. Well, I just told you. It's 1:30.
But I know. I'm saying you know what that time implies. It means it's time for our man, Chris Capre.
And before we bring Chris on, I want to note that I did put the link to the Benzinga Options Trading School that Chris runs in the description. I'm going to put it in the chat right now as we speak. Boom. There it is. Check it out. Link in chat, in description. Benzinga Options Trading School with Chris Capre. Where's Chris?
Let's go ahead and give him our new special intro. And bring him on. How we doing today, Chris?
Good. I like the new intro. How are we doing?
Thank you. Shout out Tiny Pie for that one. I did get your note that toward the second half we would like to discuss option liquidity and buying puts. But something came to my attention. I don't know if you were watching when Jake was on, but he mentioned that a lot of these candles look similar. The market's kind of trading in tandem. But I noticed, some names, interestingly, today aren't really performing with the market. Tesla, for example, is up about 7%. And has even moved higher in the past 30 minutes or so, while the Qs and while the rest of the overall markets have moved lower.
Yeah, we could take a look at Tesla. In fact, we'll make that after we look at the normal tickers I want to look at. Let's definitely take a look at Tesla and why. I
Let's
definitely
do
have
it.
information on that for sure. But yeah, can I start sharing my screen so we can start taking a look at some things?
Yes, sir, you may.
All right. Yeah, one second. I just realized that might be dimming it a little bit, and so get more light in the front. All right.
There you go.
So this is about options. I'm the head of Benzinga Option School. I want to start off by talking about SPYs, but more I want to talk about what's going on in the broader market right now. So particularly talking about SPYs. So we are in what is called negative gamma mode, and we've been in that for a while, but it's important to understand what this means. And I'm going to just give you a brief explanation of it, and then we'll kind of expand the concept. So if you buy a call and then you sell a call further out of the money, like you're buying an at the money call and you're selling it further out of the money, even though you have one long call and one short call, you actually have a long delta position. You have more positive deltas than you have negative deltas. So you're technically net long options. Now, if you start to think about that and take the perspective of what if I owned all the options in SPYs? Well, you could then collate and summate that data into, am I in a net long options or net shorts options position, net long deltas or net short deltas, and what's the gamma exposure? And when we're in negative gamma mode, that means the market is net short options. That means it is generally a put dominated market. There are more puts now, like 2 out of every 3 options in the markets are puts. And so what that does is that creates a situation where volatility is going to be exacerbated up and down. And we're seeing that the market's open and had a very strong rip on the open, but then just on the littlest bit of news, they sold off actually faster than they did buy up the same amount. So there's a situation that is kind of like influencing the market right now. And it's important to understand that you could see these rips to the upside and be thinking, it could be like this. You were watching the market like this, and all of a sudden you just see it ripping. It's like, oh my God, the bottom's in. We got a bottom. Let's start buying. And then, oh, wait a minute, the market's selling off. This is what's going to happen in negative gamma mode. Volatility will be exacerbated to the upside and to the downside. And that's because of option dealer and market making hedging. And so in a negative gamma environment, dealers will trade with the market. So as the market goes up, they'll buy shares. in terms of their hedging impacts. As the market goes down, they'll sell shares, and that pulls liquidity out of the market. So it creates a vulnerability to the markets. And that's what we're seeing in SPYs right now, is that the rally over the last 2 days, the options positioning doesn't suggest that it was real money buying. It actually suggests that it was mostly long puts that traders had, and that main dealers were short puts. And so to hedge that, dealers had short shares. Well, a lot of those long puts became 1 delta positions, which means that basically they had hugely sensitive options that if they went up or down, they were matching the value of the stock. And if the market starts rolling back a little bit, those options start losing value fast. So a few days ago, when this happened, there was a lot of puts around 420. And when the market gapped down, these puts all became Delta 1 puts. And because of that situation, that means that they overshot their targets. Traders are going to take profits. And as soon as they see the market ripping, they're like, oh my God, I just lost $3, $4 in premium in 20 minutes. So this created a long put unwind, which creates what is called a Vanna type rally. It's where implied volatility in VIX starts coming down, and the dealer's position actually, because of the hedges, starts unwinding where they start buying shares. So this created a 2-day rally. This is this day, and this day was a lot less. It was half the rally of the other day, while only down 20% less in volume. Now that fuel is out of the markets. And so since the market doesn't have real money buyers coming in, and since option traders are still holding puts, we're not seeing option traders buy calls at enough strikes and enough dates out in time to hold the market up. And so that rally is now over, and now negative gamma is taking over. And the important thing to understand is that in terms of the options market, when we're in negative gamma, news matters more. When we're in positive gamma, news matters less. And we're in that situation right now. So the situation is incredibly fluid right now. And Jake was saying, hey, he prefers short trading right now, short-term trading. I agree with that because the situation is so fluid that the market can rip up, 4 or 5 points. And you could be thinking, wow, the market's bottomed. And then any weakness in the market gets exposed and it sells off just as fast as it buys up, maybe even faster. And so you want to be quick right now. You do not want to be looking for long-term exposure because the geopolitical situation can escalate at any point in time, and traders are going to buy more protection if that happens, which means it pushes the market down. So super important that traders just understand this going into this current environment, and that they don't feel like any rip up or any rip down means that this direction is going to hold for 4 or 5 days. It's not. The market's incredibly fragile right now from an option positioning, and traders need to understand that. Does that make sense, AB?
Yeah, it makes sense to me. Jay Rice in the chat, which you mentioned this, he's asking if you look at put to call ratios, which I believe the answer to that question is yes.
Yes, but I don't examine that directly per se. I'm, more looking at what is the overall net positioning. And so, yeah, that indirectly will give me the put to call ratio, but I don't take my attention and see what's going on the put to call ratio for today and yesterday and things like that. That's important, but 1 day's put to call ratio is not going to mean as much as the larger flows in the market. I want to know what's going on the overall option positioning in the market. That's going to have more information per se than an individual put call ratio for the day or anything like that. So, yeah. Great question.
And I think, with this market environment, right, everyone has different goals. Everyone has different strategies. Some people are more traders. Some people are more investors. My thought process, in which I fall more in I trade a little bit, but I'm more in the investor side of things. Like most of my money is just sitting in long-term positions. I think right now, if you're not going to take anything off the table in terms of selling stocks and just going more cash than stocks, something that I have been considering doing is just buying some SPY monthly puts that are way out of the money that are cheap, but that if the market does drop say 10% from now in between now and March 18th, that I'll be able to recoup some money back from that. Just in the off chance something, shit does hit the fan and something bad happens and the market's tanked, that at least I'm protected to a drastic drop to the downside.
Yeah, so we actually, in the boot camp that we had last Saturday, we talked about using options as a hedge. And that's one of the reasons why you'd want to learn options, because if you are someone like yourself who's generally a long only trader and long only portfolio, and they're holding positions for long periods of time, you might suffer a lot of pullbacks along the way. And those pullbacks could be weeks or months. And there's no point in letting your cash or your performance deteriorate just because of one type of investing. Hey, I'm a long-term investor or I'm a short-term trader. If you plan on holding positions, you want to buy insurance if the market's going down. Just like if you live in California, you probably want to own fire insurance because the risk of fire could totally take out and just completely, you have no coverage or risk. You have no protection. Completely take out your investment. So I appreciate what Jake was saying, from the kind of ethical approach he's saying is like, I don't want to make money on things losing value, but you also have to protect your downside. He buys cars insurance. He buys home insurance. He's doing that because he's buying protection. He wants to protect his investments. And so, yeah, maybe you don't want to make money by getting long puts to the downside, but you still can protect your long only investments. Smart traders do that all the time. Smart investors do that. And so, okay, aside from the ethical reasons, you still want to protect your risk. You don't want to leave open-ended risk in the market. We are risk managers first, alpha extractors second. So it's super important that traders, whether they have those, ethical viewpoints or not, that they should always still look to, hey, I need to protect my downside. Because at some point, the market will have a downside move that can outsize the size of your account. And then there's no point, you're going to be sitting there going, great, I was ethical, but I blew up my entire account and 10 years worth of gains because I had an ethical position per se. You can have both. And so I think traders need to understand that options are not just a way to make money directionally. They're a way to kind of neutralize risk or reduce that risk. So does that make sense, AB?
Yeah, I think it does. And like you said, I mean, it's great if you morally say you don't want to profit off of anything going on right now, but at the end of the day, you have to remember the markets don't care what's going on or care about your portfolio. Like the prices are going to move how they move. You can either set yourself up to be in a position to either profit or not lose as much as you would have had you not done anything. So,
exactly.
I don't see it any differently as insurance, just like you put it.
Yeah. So with that being said, let's talk about, we've talked about SPYs. Obviously, in terms of stocks out there, the RSX is incredibly vulnerable right now. And, it's lost a massive amount of value in the last few weeks. And just even when the beginning whispers of situation in Ukraine came up, this started to sell off aggressively. It was fine and then gap down. Hey, there's tensions over Ukraine. Traders started to de-risk, de-neutralize, either dump positions and liquidate or buy downside protection. Since the invasion, this thing has lost over half in value in the last 2 weeks. And so while it may be a good investment long-term, if you think Russia is going to rebound and you really like the dividend, the bottom line is the short-term risks in RSX right now are insane. They're absolutely insane right now. Traders should expect volatility. If Russia ends up continuing this thing and the geopolitical and financial pressures increase, then you're going to see the ruble devalue even more and other companies start to experience more and more sanctions. The economic pain of this will continue to be a problem. So short term, you kind of have to be bearish on RSX. If they're able to exit the situation without much long-term lasting effects, then it might rebound over time and be a great dividend income earner. But short-term traders should be playing the downside. If they want to play the upside, make sure you have instant at the money puts or even in the money puts that are like 1 delta so that you, at least if it does go down, you're neutralized in terms of your risk.
I mean, realistically, this is trading at what, $12, $11 right now?
Yeah, it's the cheapest it's been it might even be in history. Yeah, in history since the ETF came out. We are pretty much at the lowest price in history. And
so realistically, if say, which I hope this happens this week, there's talks, de-escalation, the NATO and Ukraine and Russia all come to a deal. Everyone's happy. I mean, does this overnight go back to 20? Like what would you see happening?
So there's 2 things that you'd have to address to answer that question. The first is if the option positioning, and I can take a look at what the current option positioning is on RSX. Let me look at this real quick.
I mean, I imagine there are some gamblers out there that are buying some leaps on the, just in hopes that,
For sure.
Because, and honestly, that might be interesting because then you're betting on that the world's not going to end, and it's like if you're right, it's a win-win. If you're wrong, then You know?
Yeah. So this is something I've been thinking about for days now. So prior to today, RSX had about 302,000 calls and about 296,000 puts. The option volume today on RSX alone is literally about 50% of that. Like it's 328,000 options on the day. That's enormous. This is absolutely enormous. 114,000 calls and about 214,000 puts. So 2 out of every 3 options is a put. And so if the positioning now starts to align to the bear side, well, let's start thinking about this for a second. So traders, dealers, and then their initial hedging impacts. They have multiple hedging impacts that they have to do, but they have initial ones right off the bat. If dealers are long puts, or if traders are long puts, dealers are short puts. They have to hedge that risk right off the bat. So they do that by shorting shares. So that actually exacerbates the downside. Now, if the market is heavily tilted to the long puts, and then all of a sudden, let's just say they broker a peace deal. Putin's like, hey, we're backing out. We've agreed to a deal with Ukraine. We're happy about it. We're de-escalating everything right now. And then the world at the same time says, okay, we agree with this. We think it's good. We're going to remove all the restrictions and kind of sanctions. Then all that long put exposure is going to flip. And so now traders are no longer long puts. Dealers can unwind their short puts and short share hedges. They actually start buying shares on that. So then that would create an immediate sort of boost in what's going on in the markets. The problem is that some of these sanctions may linger around for a while. And the longer they linger, the more long-term effects that's going to have on the economy. So you would see a short-term bounce from the option positioning, which is definitely dominating the flows right now. But then, it would take a little bit for the longer-term effects to materialize. So maybe then short-term options to the upside, and then start buying some leaps, and far out and stuff.
Right. Yeah. I mean, and that's the thing. If you're gambling on leaps on this, you're gambling that everything gets resolved. And not only that then, the European countries and the U.S. decide, okay, water under the bridge, will take these sanctions off. Who knows how likely that is? But I just think that's an interesting, we're talking about all these different plays with everything going on. That's one that is top of the list, very interesting. Playing RSX. You can look at leaps calls, you can look at short-term puts, you can look at a mixture of both. So we'll have to keep our
call spread. You can buy a call and then neutralize the theta by selling calls further out of the money. So then you're going to neutralize some of the theta out of that, and you'll make this cheaper by selling calls further out of the money. Implied volatility is through the roof on RSX right now. So everything is more expensive. So volatility will come down for sure.
Did you see that Russia over the weekend increased the interest rate on their bonds to 20% or something?
Yeah. And that's just a sign from the central bank that the pressures are escalating. And
tremendous.
And that also puts pressure on, Vladimir to, Putin to either find a solution or escalate his pressure. It becomes kind of like this gambler's paradox in the sense of where they're already kind of pot committed in Texas Hold'em. And so it has to be like a win or bust type situation. God, I hope it never gets to that or anything like that.
I think we need to send Putin one of your Zen books on mindfulness and
yeah, I mean, it's a horrible situation, to be honest. And so, it's hopefully this de-escalates soon so that, but, I don't like talking politics, but I have to at least understand them enough to understand how is it going to affect my portfolio? How is it going to affect my trades? Because if I don't, then I might be making trading decisions without understanding the consequences of risk to my portfolio. And so it's super important that we understand that.
Yeah, and I will remind you we're a little past halfway, so if we want to get over to talk about some option liquidity and some buying puts and whatnot.
So there were some mentions about option liquidity and things like that, and the statistics actually show the opposite. Is that option liquidity is at some of the highest points it has throughout the year over the last several months. This is just December. I threw out the graphic for January, and we don't have data's full or February's collected. But options are accounting for a huge amount of the notional volume in the market as a whole, not just S&P 500, but single stocks as well. Option volumes have been growing while share volumes have been declining. And so that means that actually options are taking a bigger portion of the liquidity pie than ever. And if option contracts keep going up, there's actually there's illiquidity in stocks that were already illiquid, But for other things right now, for example, SPY, prior to today, SPYs, I mean, look at the RSX. It's done 50% of the total open interest in one day. That's not a reduction in liquidity. That's an increase in liquidity. So SPYs prior to today had about 6.1 million puts and about 11.8 million, or sorry, 6.1 million calls, 11.8 million puts. If we look at SPYs today, I'm willing to bet that's a huge number. And keep in mind, this is incredibly elevated for SPYs. SPYs was before the last several months trading at like 7-8 million options, maybe 9, maybe 10. If you're lucky, 11. Now it's doing like 18 million. So the whole thing about liquidity and options being bad, that's just not accurate, actually. Today alone, SPYs has done 10.4 million options. In other words, it's done over 55% of the open interest in one day. That's not liquidity. That's not poor liquidity. That's a huge increase in the option flows. And so, it's, I mean, right now the spreads,
if
they're 2-3 cents wide. That's normal. That's normal.
If a lot of it,
maybe it could be 1 or 2 cents, but it's 4 cents is not like, oh, the liquidity is horrible.
if a lot of the volume coming in is on the put side, people maybe hedging their positions or just expecting a big drawdown, does that matter in terms of liquidity when more contracts are on one side and it's less of a kind of 50-50 balanced even market?
It matters in terms of the dealer hedging impacts, because the dealer hedging impacts become more imbalanced. And so the dealer hedging impacts are much more kind of say threatening or problematic when there are more long puts than there is long calls. And so that is the problem with negative gamma, because again, we go back to this point right here. If traders are long puts, dealers are short puts, their first hedging, and remember they have 5 different forms of hedging activity. Their first hedging activity is short shares. That will take liquidity and lower liquidity on the share side. That will lower liquidity on the share side, but there's a surplus of options out there right now. So that will influence liquidity on the share side for sure, but it's not going to quite have, it's not like the same impact. It's going to lower liquidity on options in the same way. There's a lot of options right now in the market, more than ever. So it's not a question of there not being enough options contracts to make trades or get good prices or get filled or anything like that. Liquidity is incredibly high right now in terms of options, but it does affect the liquidity of the market because, again, they are pulling liquidity out of the market by shorting shares. So yes, that does have an impact, just in a different way.
Makes sense.
Yeah. Yeah. And we cover all this in the, the Benzinga option school. We have an entire lesson dedicated to this where we go over market gamma, negative gamma, dealer hedging impacts and all that stuff. So traders, I post a report for them every single day, Monday through Thursday, that says, hey, here's where we're at. Here's what you should expect. Here's your key levels. Watch out for this. Look out for volatility in this and that. So traders feel like they understand that. So do I have enough time to do a ticker real quick?
Yeah, of course. We've got about 8 minutes left.
Sweet. Okay. So I think, and let's talk Etsy and Tesla real quick.
Okay.
So Etsy had really good earnings, like really, really good earnings. And generally after earnings, you usually see a day of increased volume. You also usually see, if the earnings are good enough, then you'll see sustained buy prices. If it overshoots on the earnings, you see a reversal of some sort, right? Well, it's definitely still experiencing some of this upward drift, but you can see that volumes are now actually lower than the day before earnings. Eventually, this volume is going to peter out. And so it's important to understand that that could have impacts upon Etsy. Now, right now, prior to today, I haven't looked at today's volume, and I could right now, but prior to today, Etsy had about 74,000 calls and about 110,000 puts. So traders are still holding puts in Etsy. And if those puts don't get unwound soon and the volumes don't increase soon and the calls don't increase soon, there may be a little bit of rollback in Etsy before the next leg up. So as we know in earnings, generally things can have a bullish hue for a few days, maybe a day, maybe 3, but eventually that fuel wears out. Traders move on to something else. You see a pullback, and then it becomes a medium-term buy if the forward-looking earnings are good. And so Etsy might have that kind of situation coming up. So traders might want to look for short-term shorts and then medium-term longs in it. Now looking at Tesla, because somebody had mentioned Tesla on this here. And so let me see here.
That was me. I just thought it was interesting Tesla was trading higher today when a lot of growth. I mean, a lot of tech is up, but intraday, tech has kind of sold off, but Tesla never really did.
Well, tech has sold off a little bit because of the fact that you got to consider that some of the names in NASDAQ are also in the S&P 500. And so if the S&P 500 has a drag on the day, it will have an impact upon NASDAQ and tech for that matter. Tesla, though, it's kind of seeing that typical Monday call volume. So on weeks where Tesla tends to be bullish and close bullish, you usually see a rush of calls come in on the Monday, and they're usually weekly expiries. So Tesla is now becoming, that thing where there's a lot more short-term day trading in Teslas. And so traders tend to, if the circumstances are good, they will start buying a lot of, long calls on Monday. And then if they make their money, they start closing out Tuesday, Wednesday, Thursday. That's what we're seeing right now. Tesla's prior to today, option volumes have been coming down in Tesla for weeks now. Prior to today, 1.9 million calls and 1.9 million puts, almost even money, basically in terms of calls and puts. Today, though, 1.2 million calls and roughly 800,000 puts. So 12 out of every 20 options have been calls. So it was balanced, and now it's skewed. And so that's obviously skewed the upside. Share volume is decent. It's right now at the 10-day average. So that's solid. It's not gangster, but it's solid. But I'm willing to bet that this is hugely dependent upon short-dated calls, kind of entering the market. And keep in mind, short-dated at-the-money calls have the highest rate of gamma change. So that changes the short-term hedging impacts by dealers. So it's super important traders understand that in terms of how that affects flows on a day-by-day basis.
Got it.
Okay, let's see, just a couple of comments. Cypher, DMG, Benzinga Option School is awesome. I'm part of the program. It's changed my trading career. I'm glad to hear that, Cypher. Thank you for sharing. That's awesome.
Yeah, link should be in the description for everyone to go check it out. You have no reason not to. We're lucky enough to get Chris on the show once a week every Monday. But if you want Chris's insights every single day, make sure to go sign up for the Benzinga Option School. Looks like MD wants to look at Zoom. I haven't checked out Zoom in a while.
I haven't either. So what's interesting is that Zoom, when the pandemic started, over a short period of time, it gained like almost 500%. And it should have, in the sense of part of that was due to speculation, but part of it was the entire global economy was shifting to online. But now that we're a few years past that situation, those stocks that had both a boost from COVID and a huge speculative boost, that speculative boost is no longer there. So they're kind of returning back to earth to some degree. Meanwhile, like Hilton, if you think about that, Hilton hotels, they had taken like a 40% hit when COVID hit. And now, since COVID hit, they're actually up 33%. They're actually up higher than Zoom percentage-wise, because now that the market has returned back to normal, the real things are starting to matter a little bit. At least in terms of COVID, the market has returned much more back to normal. And so things are much more back down to earth. Valuations are starting to matter. Business models are starting to matter. Profitability is starting to matter more than ever. Go figure, eventually that does catch up. So in terms of Zoom, let's take a look at this. But prior to today, Zoom had about 331,000 calls, and it had about 312,000 puts. On the day, it's actually a solid day in terms of options volume. So you're talking 650,000 options. Today alone, it's done 166. So again, the liquidity thing is not, it's kind of overstated in the sense of there's a lot more trading now than ever. Options volume is generally one of the biggest movers of price action right now than anything else. If share volumes are down and options is up, it's more of an impact. With that being said, I'm not seeing a whole lot of short-term options in Zoom. In other words, the majority of positioning, if you were to collate that, like if you owned all the options in Zoom, you would be able to see, do I have more short-term, medium-term, long-term? You would see where it's all collated. More of it's collated to like the March 18th expiry. So because of that, theta, volatility, gamma impacts are much more smoothed out. And that means that it smooths out the hedging impacts for dealers as well. So I'm not seeing anything short-term that's kind of yanking at it one way or another. But Zoom is kind of in a situation where if it can stay above, 135, then the dealer hedging impacts become favorable until it gets about maybe 150, 155. And then dealers actually start hedging against it. So let's look at that on the chart. Let's mark it. And let's see if that makes sense technically. Yeah, It's
And just got a note. Zoom does report earnings today. MD saying in the chat. I'll double check that real quick.
Yeah,
So,
right there. March 1st, tomorrow. So absent earnings, if earnings didn't exist, Zoom would probably start to experience resistance and hedging impacts between 147 and say 156. However, after earnings, it could obviously have a material impact upon positioning changes and things like that. You are seeing a volume buildup going into earnings. So that could be both stock share volumes and option volumes that are influencing that. So it could have a pretty volatile, post earnings session tomorrow. I'm not sure if it's before or after market.
It is today after market.
Today after market. Okay, yeah. Okay. So then, the next day or two for Zoom should be pretty volatile. You should expect volatility to be pretty solid, and then a fair amount of options come off the board. Yeah.
Got it. All right. Well, it is 2:00. That does mean we have to wrap. Chris Capre, thank you again for coming on the show. You can get more from him by signing up for the Benzinga options course. Link should be in the description. Chris, thank you again. Have a great rest of your day.
You do the same. Cheers.
Cheers. All right, y'all. Coming up now, we have Moon or Bust with our crypto experts, Ryan and Logan. Gonna hand it off to them. Ryan, what are you guys talking about today? Polkadot, Pixelmon, and Parallel Finance. So if you want to learn more about the wonderful, wonderful world that is crypto, make sure to hang around. This video will automatically redirect you to Moon or Bust. So stay tuned. And don't dare going anywhere. No other YouTube channels, no other TV channels. Just stay right here. We'll be back tomorrow, 11:30 a.m. Eastern, as we often are.
This is